The Fed held steady, but with markets on edge and tariffs back in the spotlight, the big question now is how long can the central bank afford to wait? We'll break down fresh remarks from Fed officials, plus we'll take a closer look at what's really moving the dollar right now. I'm Johanna Bota, and with us today is StoneX Senior Advisor Jon Hilsenrath. Jon, welcome.
Thank you very much for having me.
So last week, the Fed did what everyone expected, except maybe Trump. It held interest rates steady. So how long can the Fed afford to sit still before the data or the markets force its hand?
The Fed has the view that it has no alternative because, it has two mandates that it's trying to live up to. There's an inflation mandate where they're trying to reach a 2% inflation objective. And then there's a full employment mandate where they're trying to keep the unemployment rate low, in the low 4%. Right now, the economy is pulling it in away from both of those mandates. So inflation is above the 2% inflation objective, and the economy appears to be slowing down, which could put upward pressure on the unemployment rate. They're damned if they do, and they're damned if they don't. If they cut interest rates, the worry is that they're going to cause inflation pressure and move farther away from the inflation mandate. If they hold steady for too long, the worry is that the economy will keep slowing and might go into a recession. So they don't feel like they have a very good alternative right now.
So we had a couple of Fed presidents and board members in the last couple of days give speeches. For example, we had Beth Hammack, Cleveland Fed president, in her speech on Friday in California, emphasized the need for, quote, clear and convincing evidence before adjusting interest rates. So given the relative data that we're going to get before June, how is the Fed supposed to navigate this economic picture if there's really not going to be anything concrete given to us before then?
Well, I think you're spot on. And what I've been saying, and my colleagues like Catherine Rooney Vera have been saying, is that a Fed move at the June meeting is unlikely. We've been saying this for several months, and the futures markets are finally catching up to that. The fact is, the one set of data that could move the Fed by the June meeting towards a rate cut would be a really weak data that shows a really weak job market. But we just haven't gotten it so far. The report for the April employment report was actually pretty strong. You had the unemployment rates holding steady at 4.2%. You have payrolls continuing to expand at about a trend rate. Maybe they've slowed down a little bit. So in order to directly answer your question, in order for the Fed to move by the June meeting, we would have to have a really terrible jobs report for May. And it just doesn't seem like we're getting that. The economy was hit by two shocks in the first 4 months of the year, an uncertainty shock and a trade shock. But what you see in the underlying data on demand and hiring is that while people are kind of slowing down and holding back on some of their decisions, they haven't moved into a retrenchment mode, the kind of mode that signals the economy is in recession and companies are laying off workers and people are really cutting back spending. We're just not there yet, and the Fed is on hold. They can't move preemptively to forestall a recession because they also have to keep their eye on inflation.
Well, I would say everybody is on hold because of all the uncertainty. So let's discuss the dollar and obviously the interest rate differential between the ECB and the U.S. and how that impacts the dollar versus, let's say, policy, because it doesn't seem like policy is impacting it anymore. It seems it's more driven by tariff announcements. So which of these is the biggest driver?
I would say the biggest driver is sentiment about the United States and the idea of whether, in particular, U.S. Treasury bonds are still the premier safe haven asset in the world. So you talk about interest rate differentials. The interest rates are moving now in a way that would suggest that the dollar would be strengthening, right? So the ECB has been cutting interest rates, so you get a lower return on short-term euro assets, and the Fed has been holding interest rates steady. So as that gap widens, it suggests the dollar should strengthen, but the dollar weakened in the first few months of the year. And that's because, a lot of investors globally are saying, do I want to hold US dollar assets? Is that the safe haven to have in a time of uncertainty? And the net answer seems to be that it's losing some of its safe haven value. So the dollar is one example of that. And what we see happening with gold is another example of that.
Yeah.
People are moving into gold assets as an alternative to US dollar assets in this kind of environment.
That's correct. Well, thank you, Jon, for all your insight. And thank you for watching. For more financial content like this, please like and subscribe to our channel.